Welcome on board Venkatraman Venkateswaran, the Group President and CFO, I beg your pardon, of Federal Bank, joining in right now to talk about how their earnings were. Venkat, hi, good to have you on the show. First, let's talk about your provisions this quarter because you've taken a very accelerated provisioning, causing credit costs to also go up and also impacted your profitability. Tell me why this move?
Yeah. Good morning, and thank you for having me on your show. Firstly, I should summarize it's been a very strong operational performance for us this quarter. We had the best ever NII and also the best PPOP ever, 1569. So, from an operational performance point, it's been the best quarter for us. Your question about the accelerated provisioning, now this is more a question of lead lag. These provisioning are purely for the non-performing assets. And it's a question of if we didn't do it now, it would catch up over a period of time. And we felt this is the right time when the unsecured part of the book is at a very small percentage and get the foundation even stronger, because later when the market turns and we have a better opportunity to grow, at that time this will position us well. So this is more of a proactive decision to kind of take in the provision now. And if you see the other metrics, overall the bank's performance, like I said, is in a very solid quarter of performance. Our LCR has improved. The NNPA, net NPA ratios is also down. So, one should look at this in the context of the external environment and how we are positioning ourselves for the medium to long term.
Okay. The trajectory of numbers was strong. Suddenly comes the odd bump in the last quarter. Was there something extraordinary which has happened which could be called as one-off?
Nikunj, in the sense, this is, if I say this as one-off, if it were not for this accelerated provisioning, our net profit also would have been the record highest ever. But like I said, it's a conscious call taken at this stage where we believe that doing this now builds the foundation for us to be growing on a very strong footing as we go forward. And the market, as you see, we could have chosen not to do it now, but then this will eventually catch up. Over the next few quarters, the credit cost will come. It's not that it's not going to happen. We were following the IRAC norms. We were providing as per the regulatory requirement, but then we felt it's better to get into the league of the best in class, and that's how we have benchmarked and made this accelerated provisioning.
Now, I have a simple question that the need for provisioning comes when you suspect something, right? When you've given loan and you think that the loan will not be repaid. While we appreciate the fact that you are you're following best standards, but the fact that provisioning is coming because you are not comfortable or you suspect that the loan will go wrong. So let's understand the first why here.
Like I said, Nicholas, this provision is purely on the non-performing book. This is not on the standard book. So there is no question of doubting what is likely to happen or there may be something coming up. So I repeat, this provision is purely on the non-performing book. If it doesn't come now in the normal course as per the IRAC norms, it will come in subsequent quarters. What we felt is it's better to take it now. And the external environment is not very conducive to be growing the unsecured at this stage. So, and it's a quarter of reorientation. If you've seen the key messages which we have shared, we have kind of made sure that we get the averages growing on the liability side as well. And Nikunj, you are aware our philosophy of fund before lending. We want to make sure we have quality deposits and make sure that the advances are in line with the deposit growth.
Okay. So your commitment to grow at in and around 20%, which is what our conversations with the management of Federal Bank is. Will that change? Will that stay intact, or economic conditions could force you to rethink it? It is not related with Federal Bank. It could be related with economy and the slowdown which is happening.
Yeah. See, our growth, like in the past, should always be seen in the context of the growth in the industry. And we will be around 1.5% of the system growth. So that is something which we will continue to do. If the overall system growth slows down, obviously you will see an impact of that on us. But our endeavor has always been to be at 1.5 times to the system growth, and that doesn't change. Now, whether that is 20, 18, 16 depends on the overall system growth.
What to your mind is the system growth? Because the system growth is always a multiplier on India's GDP. The GDP is now sub 7%. Same time last year it was comfortably above 8%. So obviously the system growth will come down. So what is your assumption for the system growth, and at what premium you will grow at from the system growth? Just to get these numbers right so that we can flash it.
Sure. See, if you look at our GDP growth estimate for the year, and the nominal GDP, if I take, I'd say around 10.5 to 11%, 1.5%, 1.5 times of that. So around 15, 16% is what we are currently looking at in terms of growth going forward.
Okay. One of the most remarkable things for Federal Bank has been the cost to income ratio, and it is beautifully coming under control. Where is that journey moving? Cost to income ratio, where will that start moving?
Yeah. The cost to income ratio in the current quarter, as you see, it's around the same as previous quarter. But like I said, based on the distribution and the branch networks which we have been opening over the last few years and which will continue for one more year, the benefits of these will start accruing over a period of, say, in the next 2 to 3 years. Our endeavor is in the next medium term, say 3-year time, we should be sub 50% on the cost income trajectory. That's what we are working towards. It's both on the cost and on the income side. So our income has to grow much faster, including fee income, and costs have to be under control.
If you maintain this growth of 18 to 20%, or I can use a broader band of 16 to 18%, at what point in time you would be required to tap into either tier 1 capital or equity capital?
Yeah. See, current tier 1 capital, as you see, doesn't reflect the plowback of retained earnings, which will happen only after Q4. So if tier 1, once we add that, we will be comfortably above the 15% mark. But having said that, at this stage, there is no thought process or discussion about tapping the markets for raising capital. Maybe at an appropriate time, we will look at that. But like I said, it's a combination of growth, how well we grow, how well the outlook changes, macros improve. And based on all those factors, we'll take a call when to raise capital. But at this stage, there's no discussion on tapping the market.
Follow-up questions for you. One is purely going back to the macro. The general view on the economy is that economy or GDP growth will come back, the government spending will pick up, second half will be better than first half. Will that apply that to your credit growth also? Like you said, it's a multiplier on the economy. If economy goes back to 7.5%, then can credit growth in the Q4 and Q1 could be substantially higher?
To a large extent, yes. But what is important is to peel that growth in terms of which segment of our advances will grow. Because we don't want to be growing for the sake of growing. So, like you've seen in the last quarter, growth in MFI has been barely, less than 1%. Corporate banking, where the margins are wafer thin, is also lowest amongst the wholesale. The sweet spot for us is the SME, mid-market, BUB, gold loan. These are the segments which are growing quite well. And even in the retail side, home loan versus LAP, we are trying to be conscious of where we can get that marginal uptick in the margins, which will help sustain and improve the NIMs. And on the liability side, see the growth in the NIMs is impacted by both. So the growth will come, but where we grow, which segment we grow is important. And I want to bring in the liability aspect as well, because NIMs are impacted by both liability and asset. It's not just an asset game. If you've seen last quarter, our average CASA has grown quite well as compared to the levels. Levels may look flat, but my average SA is over 2.3% growth. CA has grown 1.5%. So as we change the metrics, reorient to more towards growing the liabilities, better quality liability, that will help improve the NIMs as well. And the other factors, see, there are several things which are in play. The LCR is another example. Last quarter, we ended the Q2 end LCR was, say, 111. We're at 133. Average LCR, we are at 119 this quarter. So, shedding off the liabilities from financial entities, shedding of wholesale deposits, shedding of high cost, reducing concentration of top 20. All of these are starting to play into the different metrics. So if we have to make sure it's a balance of several factors, it's not just NIMs or credit cost, or so we have to look at LCR, CD ratio, growth, margins, a combination of several things.
Why your deposit growth in between quarter has gone down?
Like I told Nikunj, you are looking at the period and levels. If you look at the averages,
I'm purely looking at the quarter-on-quarter number, sir. I mean, this is a reported number. I'm just trying to understand clarity because markets are judging these numbers. Yeah. See, for me, I look at Federal Bank, a bank which in last 8 to 10 quarters has demonstrated excellence. Low in NPS, great on growth, strong on deposit. It's only that when you see that quarter-on-quarter number which was going up every quarter, it has gone up every quarter, but suddenly I see a 1% downtick. So
that's what I was telling earlier. Nikunj.
Okay.
What is the reason one should understand is because we have taken a deliberate, conscious call to reduce the concentration from top 20, reduce deposits from wholesale period and deposits, reduce the deposits from the financial entities. All of this, it's been a sizable reduction. So overall, whilst the retail deposits has moved up, granular retail deposits is what we are focused. The high cost deposits has come down. So that's the reason why level to level comparison, you see it being flat.
I just wanted that clarity because, CASA is a number which markets are obsessed with when there is war for liabilities. I'll wrap it up with one simple question. There is a lot which is being discussed about MFI and a lot is being discussed about unsecured. As percentage of your total book, correct me if my numbers are wrong, but you have only 2% exposure in MFI?
Yeah, the overall retail unsecured is less than 5%. And MFI is less than 2%, Nikunj. And having said that, the MFI industry is going through that bit of stress. It applies to all in the market. And we believe probably 1 or 2 more quarters it will play out.
And just to wrap it up with the final question, while I understand and respect that Federal Bank is board driven, it's an institution, cadre based organization, but CEOs do play a role. So what is that one thing which has changed after Shyam's departure and what is that one thing which has not changed? You can be frank about it, even if you don't like about that change.
No, I think, one should recognize that, the foundation which Shyam has built has been solid. So it's just building on that strong foundation is what Manian is focusing on. How do we ensure that we continue to have quality earnings? How do we ensure that our advances balance sheet growth is built on strong foundation, it's quality. See, you have to also ensure it's not growth for the sake of growth. We want to make sure that the earnings quality, growth quality, return to shareholders, all this and are built on strong foundation. So there is nothing that a new CEO, of course, we'll hear more about the new CEO's strategy in the analyst meet on 21st Feb. But having said that, it's a reorientation in terms of making sure, like I said, a few of the things which I said, focusing on average growth, focusing on margins in the medium yielding segment. See, one could always take a strategy of the, like Manian says, dumbbell strategy, MFI on one end and low margin corporate on the other end. But that is not, there's something in the middle which is working quite well and we are building on more on that, whether it's gold loan, BUB, SME, better liability, average CASA growing. So average is what gives you the earnings. So these are all the focus and we continue to do on that. And like I said, foundation is strong. That's why the operating profit is extremely good. It's a one-off accelerated provisioning which we have taken. We believe it's better to be prudent at this stage and get the foundation very strong because when the growth comes, and we will be growing the unsecured, it's not that we are going to be shying away from it. Opportunities will come. We'll be better positioned to capitalize at that time.
Venkat, it's the first time I've interacted with you personally. So lovely to talk to you and hope to see much more of you going forward.
Thank you, Nikunj. Bye.
If you like this video, then like, share and subscribe to ET Now.